Perfect. All righty, guys. So we're going to start off with chapter 1, completing the application. Make sure you take notes during this process. This really does change a lot when it comes to completing the application. Like I said, I'm going to teach this chapter, and I'm going to break down definitions, break down really the mindset when it comes to the test. Give you a little bit about my story. I took the exam 5 times. The 4 times I got a 57, 59, 67, 69. You need a 70 to pass it. The 5th time I got an 82 on it. That's why they call me Mr. 82, because I'm the greatest. At least I claim that I'm the greatest. But one thing that I learned is that if we self-teach ourselves, we sometimes can get definitions and misconstrue definitions and verbiage. Most of this exam is vocabulary. So if we can learn the vocabulary with just the minor understanding of how they're asking the question, you're going to pass this exam with flying colors. So the first thing we want to look at is adverse selection. Adverse selection, Ceci, is when they're insuring risk are more prone to loss than the average risk. So if somebody is average, their health is fine, and someone has maybe high cholesterol or what's the word I'm looking for? High blood pressure, they might use what is called adverse selection, meaning the way that they approve the policy, they might have to go through further underwriting. The agent is the person that is writing the application. You, when you get licensed, you become the agent / producer. The applicant or the proposed insured is the person that's applying for the insurance. When you are buying life insurance, you're applying for insurance. You don't automatically buy it and get approved. You have to go through an underwriting process. Now, the reason we buy life insurance is that if God forbid something happens, we leave money behind to loved ones that we call those the beneficiaries. The beneficiary doesn't have to be someone specifically, doesn't have to be a spouse, your children. It could be anybody. So if you guys ever get the notion of, hey, listen, I want to add Miguel to my life insurance policy, you're more than welcome to do that. Now, when someone passes away, you're getting what is called your death benefit. This is the amount of money that's paid to the insured beneficiary. I want to give you something very cool. The death benefit, the check that the family receives, is a tax-free check. The government can't put their hands on that money. It's literally a tax-free check. So if a family's covered for $500,000 or $1 million and a loved one passes away, that family receives $1 million. Now, fraud, this is essentially saying, hey, listen, you lied on the application. You're intentionally trying to misrepresent your health or misrepresent the application to deceit, which people have done. People have lied on insurance applications and have been found on fraud. And you as the agent have to be careful of that. You have to sniff that out. An insurance policy, it's a contract between the policy owner, which the policy owner can, but doesn't have to be the insured. The policy owner can be someone that is not the insured. I'll give you an example. If I take out a life insurance policy on myself, I'm the policy owner and the insured. But I can take out a policy on my father, which he is the insured, and I will become the policy owner. So as we move forward, the policy owner does not have to be the insured. An insurance company agrees to pay the insured. So if the insured passes away, the insurance company promised to pay the death benefits to the beneficiary. The insured is the person covered under the policy. The insurer, also known as the principal, that is the insurance company. So if you've ever heard of the company that we work for, that is the insurer. The insured is the client. The agent or the producer would be you. Now, if someone says, hey, my policy lapsed, that is typically someone is, hey, listen, they missed a payment. And after 30 days, if their policy missed a payment, their policy will lapse due to non-payment. No. And I'll cover something what's called reinstatement in a second. Again, policy owner is the person who has all the rights and privileges to the policy. Like I said, I'll give you an example. If I decided that I wanted to take out a life insurance policy on my father, I could, because there is what is called an insurable interest. An insurable interest is where if something happened to my father, we would assume financial loss if we were relying on them. Or God forbid, if your husband or wife, you take a life insurance out on each other because if something happens, now you got to have money to fund and make sure the kids' lives and your lives are taken care of. An insurance contract. An insurance contract is just a transfer of loss from one individual or business entity to another. See, if you look at the way life insurance companies work is, if they insure a person for $1 million, we know as a life insurance company, the possibility of that person passing away are there, but they're slim. So insurance companies take on life insurance premiums every month from so many clients. So they're transferring the risk. They're going to inherit the risk from, hey, we're going to insure this family for $1 million, but we're collecting $5 million a month of insurance premiums. So when we transfer the risk of loss, if God forbid something happened to a loved one, right? You buy an insurance policy on this loved one, and you're saying, hey, if something happens to this loved one, this insurance company contract is going to replace that person's income, which is obviously the death benefit. Now, let's talk about the legal elements of a contract, okay? This is something that you want to make sure you almost memorize this. In order for an insurance contract to be legally binding, there's 4 essential elements in this. Agreement, which means you give them the quote, you offer them, hey, listen, you're going to get $150,000 for 45 hours a month. Then Primerica accepts the application. They approve the application. So that's called offer and acceptance. They offer the premium. Primerica accepts the premium and the underwriting. That's offer and acceptance. Consideration is where, here, let me just read this right here. Consideration is something of value where each party gives something. So, and the insured and the insurer, the insurance company, the insurer says, hey, I'm going to pay my premium. The insured says, hey, listen, if you pass away, we'll pay the death benefit. But as long as you pay your premium, we'll pay the death benefit if something happens. So you're both giving up of something of value. The second one is competent parties. Competent parties is very simple. It's just as it reads. They must be capable of entering a contract in the eyes of the law. Generally, this requires both parties of legal age, mental competency to understand the contract, and not under the influence of drugs or alcohol. One of the questions you'll see on the exam is they'll add those 3, and then they'll say, all the following are true except. And then they'll throw in a high school diploma or high school education or college education. Well, you already know based off of what this says, it's not going to be that education one. So you don't need that for the competent parties. 4, legal purpose. The purpose of a life insurance policy must be to replace the loss of income or tragedy or transfer of loss to a loved one or a business. You can't go out there and buy an insurance contract on some random homeless person on the side of the street. There has to be what is called a insurable interest, and the insurable interest can only come from immediate family. So I'll give you an example. A loved one like myself could take out a policy on my children, my spouse, my parents, or business partners. I can't take out a policy on my brother or sister. I can't take out a policy on a random cousin or a grandparent. It has to be an immediate family that if something happens, my family would suffer financially. Now, let me give you the purpose of business partners. If you and I go into business and we have a corporation, and if God forbid something happened to me or happened to you, we want to make sure that we have life insurance to you and me, that the money would go to the loved ones to pay off that portion of the business, so the whole business goes to the remaining beneficiary. Let's go to distinctive characteristics of an insurance contract. A contract of adhesion. I want you to, when you see the contract of adhesion, I want you to write, take it or leave it. You'll see it right there. Take it or leave it. Contract of adhesion says that the insurance company is going to say, hey, listen, we will insure you for $100,000 of coverage for $20 a month. You can't go back and try to negotiate it and say, well, let me give you $15 a month for the same $100,000. They say, no, these are the terms and agreements. Take it or leave it. If you don't want it, move on. Second one, aleatory contract. I want you to write this one down. This says unequal exchange in values, which means you're going to pay $20 a month for $100,000 of coverage. We know that the insurance company is taking the bigger risk. So it's an unequal exchange in value, which is where aleatory contract comes into play. And again, you guys can come watch this video on here. The third thing you want to realize, it's called unilateral contract. Unilateral, meaning one. Unilateral contract. This is where only one party is legally contracted to the policy. See, the great thing about insurance is you can cancel an insurance policy at any time as the client. But once the policy is in place, the insurance company can't cancel you. So as long as the client pays the premiums and they pass away, the insurance company is obligated, legally obligated to pay that death benefit within the terms of the contract. So they can't just randomly come back and deny your claim because you only pay $20 a month for 2 months and God forbid someone passed away. They're still on the line for that $100,000. So that is unilateral contract. And if you guys have questions, feel free to put in the comments, guys. Now let's talk about conditional contract. Conditional contract requires that conditions must be met by the policy owner and the company in order for the contract to be executed and before each party fulfills its obligations. For example, the insured must pay the premiums and provide proof of loss for the insured to cover the claim. That means if someone passes away, you must show a death certificate. It must show an autopsy before the insurance company pays the claim. You can't just be gone for 30 days and be considered passed away. They need some type of proof that this person did pass away. Third one, representation and warranty. When you see the word warranty, write the word guarantee next to it. When you take as a warranty, it's an absolute truth statement. So based off of what you're saying, hey, listen, your health is clear. You're saying everything that you are saying is true. So a warranty is just saying, hey, everything I'm saying to the best of my knowledge is true. And I want you to write the word guarantee to that because that's going to come back later in the study. Representations are statements to believe that are true to the best of one's knowledge, but they are not guaranteed to be true. See, warranty is true. Representation is not guaranteed to be true. Now, let's talk about untruthful statements on the applicant to be considered as misrepresentation and voided contract. If you purposely say, hey, listen, on the insurance application, they ask you, are you a tobacco user or you're a non-tobacco user? If you say, well, I have like 1 cigarette a month, you're still technically a smoker. So if you said, well, I don't really want to pay the extra premium, I'm going to say I'm a non-smoker. And if you pass away in the first 2 years, that is called misrepresentation, and your contract will be voided and your family will receive nothing. Which is where, as you as the field agent, you as the agent, it is your job to collect accurate information to make sure that you do the right thing by the company and the client. Material misrepresentation is a statement, if discovered, that they would alter the underwriting decision Furthermore, material representation is intentional. It is considered fraud. So if they find out later, hey, I had diabetes 6 years ago, and you choose to not tell them about it, and they find out later that you did lie on the application, well, guess what? That's called misrepresentation, which is intentional, and that is considered fraud. So I want to come back. Does anybody? I want to open up the lines. Does anybody have any questions so far? Hopefully I can see you guys. Any questions so far? Is everyone good so far? Okay. So let's go on to the next thing. Knowing the application. So completing the application. Completing the application is so easy, Jason. All you're going to do is you're going to collect their information, their name, their full name, their marriage status, your occupation, their gender, their income. So that's their general information, things that you would put on a job application, things you would put on any application. That's part one. Medical information. Now, this part is where it can get a little bit tricky. As the agent, again, you are going to be in charge of collecting the right information. Most of the underwriting that the company is going to go based off is based off of the application. So information on the application, on the medical part, is you want to make sure that you ask the questions properly. You get, if they've had any kind of medical questions or medical challenges in the last 10 years, that's where most of the time it goes back. Are they on any kind of current medication? Do they have any history of like family illnesses? You'll see this stuff on there, on the actual application. But this is, when you're taking the exam, that's generally what they're going to be asking you. The good thing on the exam, they're not going to ask you detailed things on application. It's literally definition. The field underwriter is who? Oh, it's an agent. I'm the agent. I'm the front line of the company. I'm the field underwriter. Because the agent is usually the first person who solicited the insurance, as a field underwriter, the agent has the most important responsibilities and during the underwriting process and beyond, including the following. Make sure you explain it. Help prevent adverse selection. If they smoke, if you see them, they're on a breathing tube and they look like they're going to die, don't write the application. That prevents adverse selection. Completing the application, make sure you fill out all the documents. Obtaining the right signatures, that's pretty simple. Collecting the initial premium. So when you do an application, you collect the first month's payment up front. And they are what is called conditionally covered. The moment someone submits an application and pays the first month's premium, they're going to get a conditional receipt that if God forbid something happens, from you submitting the application to you going to your car, if they passed away, they're covered. How great is that? That they don't have to wait a week or 2 weeks to get covered. They're covered immediately the moment you submit the application with the payment. And it is your job also to deliver the policy. And when you deliver the policy, answer any questions that they might have. I've kind of, I guess I did the bullet points for you. You can go back and read this, guys. Let's talk about replacement. The greatest thing about our business is replacing crappy policies. If people have companies, policies like State Farm, New York Life, Prudential, Liberty Life, Mutual of Omaha, all these other companies, Farmers, bum, all states, doesn't matter what company they have. If someone has a policy at another company, it is your job to make sure you do the replacement part. And all you're going to say is, hey, listen, let's find out what coverage you have. Let's see if we can do better, which we're our company, we can always do better. Our policies are better than everybody else's. And all you do is collect the information. You're just going to report to Primerica that you're replacing a policy. Primerica will deliver a notification to the other company that they're replacing a policy. So you just want to make sure you collect all the data. But when you replace a policy, that doesn't automatically cancel their policy. The client still has to call, email, fax in a letter, whatever their cancellations is, to cancel the policy. We do not replace policies for the purpose of just generating a commission. We will never do that. If we sit down with somebody and their policy is better than ours based off of them buying it at an earlier age and their health is just we can't do anything for them, we will not replace that policy. Integrity is always first. Now, underwriting. Underwriting is the risk selection and classification that involves different factors to determine the acceptability of an applicant. In other words, underwriting is the process in which insurance companies determine whether an applicant is insurable or not, or if they're going to be charged extra premium. Remember, we're going based off of the application, but sometimes when you do an application, I've had clients lie. I've had clients forget to tell me, hey, they're on prescription medication. Just because they tell you it doesn't mean the insurance company won't find it. They have what is called the Medical Information Bureau. It's the MIB. We'll pull this up later in the studies. But the MIB, Medical Information Bureau, they have access to all the medical records. So if someone has had surgery in the last 5 years, open heart surgery, and they said, oh, I'm healthy. Well, guess what? They lied on the application and they're going to get denied. There's no way about it. They're going to get denied. So as your job in the underwriting process is try to get as much accurate information as possible. Now, let's talk about insurable interest. I talked about this earlier. To purchase insurance, you must have insurable interest. Now, the insurable interest is between the policy owner and the insured, not the beneficiary, between the policy owner and the insured. So, Jason, if you wanted to get a parent on your policy on your parents, you have an insurable interest. If you have a wife and you have kids, there is an insurable interest. If you have a business partner, there is an insurable interest at the time of the business relationship. We can't be in business today and then wait 10 years later when the business is done to take out a policy on me 10 years later. You have to do it at the time of the business is around. Like I sometimes have clients say, hey, listen, can I take out a policy on my baby daddy? Are you with him? No? Then no, you can't take a policy. There's no insurable interest there. If you were together, then there's an insurable interest. So I just pretty much broke down what this means right here. So in layman's terms, I broke down what insurable interest is. Insurable interest must exist at the time of the application. The policy owner must have an insurable interest in the life of the insured. Let's see. Agent's report. Agent's reports allows the agent to communicate with underwriters. So you have a note section on the application that if you saw something that they didn't tell you, but you wanted to inform the insurance company about it, just so there's more accurate information, you can write notes in there. Right here, this is called the Investigative Consumer Report Inspection. I can't tell you if I remember what the hell that meant. All I can tell you is the supplement of information on the applicant. The underwriter may order an inspection report on the applicant from an independent investigative firm or credit agency, which covers financial and moral information. This is general reports of the applicant's finances, characters, work, hobbies, habits. Companies that use inspection reports are subject to rules and regulations outlined in the Fair Credit Reporting Act. I cannot tell you I've personally ever heard of an insurance company do this. Can't tell you they haven't, but I can't tell you that they have. So if you just know that definition, you'll be fine. Fair Credit Reporting Act. This is huge because this protects the consumer that if they are denied on a report, the consumer can find out, hey, listen, why was I denied? Why was I denied? The investigator report, you might want to come back and read this. The reports made under a consumer advises writing report must be report within 3 days of the date of the report was requested. So these are little dates you may or may not see. It's better to know them than to not know them. Consumers must be advised that they have the right to request additional information concerning the report, and the insurer and reporting agency has 5 days to provide the consumer's information. Again, we're going to come back to this. Let's go to the Medical Information Bureau. This is a nonprofit trade organization. This is what I was telling you about. This is a membership corporation that is owned by members of insurance companies. Insurance companies share their information. So this is funny. You'll have someone apply for a policy at State Farm, apply for a policy and get denied, then apply at Allstate, then apply at Global Life, then apply at Primerica, and then they don't think that they share the same information. If you get denied over here, you're probably going to get denied at all these other places. Does that make sense? So that is the reason the Medical Information Bureau is there. It is to protect insurance companies and the underwriting process. An applicant cannot be refused simply because of some adverse selection discovered in the MIB. So if an applicant is denied from an insurance company because of the information here, they can always do what is called reconsideration. They're not always stuck to just whatever's there. They can always apply for reconsideration. Medical information, medical exams. Insurer may request paramedical reports, which are doctor medical exams. It may require you to do blood and urine depending on the underwriting. The underwriter may also require attending physician statement. This is where they ask your doctor to release medical records to the insurance companies, and they kind of look through your stuff. Generally, this will never cost the customer. You will rarely see any of this stuff on the test. I've never seen any of this stuff. And in the real life, you will definitely see this. I'll teach you how to do this stuff in the real field, but I doubt you'll see this on the exam. HIPAA, you want to know this. HIPAA is the Health Insurance Portable Accountability Act. This just says that everything you say on your medical records, you believe to be true. Insurance companies cannot disclose this information. They can't share this information with other people without your permission. So this is something very true. Just for your own personal stuff, you want to know that you have HIPAA laws that protect you. Risk classification. This is very simple. Write down risk classification. There's 3 types of risk when it comes to coming down with an application. There's preferred, which means you're healthy. I mean, you're the healthiest as it can be. There's standard risk, which is average, your ordinary person. They're not overweight. They don't have any health conditions, but they're also not the healthiest. They're not the thinnest. They're not the most shaped. Then there's what is called substandard. This is your higher risk. These are your people that are probably overweight, people that are on medication, people that are diabetic. Those are your substandard. If you are preferred risk, generally you will save money on your payment. Standard, it's your standard payment. When you get substandard, we also call that rated. You will most likely pay a higher premium every month. Applicants who are rejected are considered declined risk that the underwriters assess that are not insurable. That just means, hey, listen, you got something in your medical records that they just don't want to even take the shot on it. Like if someone has had a felony in the last 10 years for something very drastic, insurance companies will deny you. If you have cancer, if you have tumors, you have AIDS, you have anything major, heart attack in the last 10 years, and you're still on medication or treatment, generally they're going to deny you for that. Now you have what is called STOLI. This is the Stranger or Originated Life Insurance Organization. STOLI is a life insurance arrangement in which a person with no relationship to the insured purchases a life insurance policy on a life with the intent of selling it to an investor and profiting financially when the insured dies. In other words, STOLIs are financially purchased solely for the intent of selling them for life settlement. STOLI is a violation of principle of insurable interest, which is in place to ensure that the person purchasing life insurance is actually interested in the longevity rather than the death of the insured. Because of the insured takes aggressive legal stance against policy suspects, Stoli transactions. I've never met anybody that has done a Stoli. Stoli, if you don't understand that, Stoli is something that you're going to buy an insurance policy on someone who doesn't have an insurable interest in you, and you're just waiting to cash in on the death benefit. So Stoli, I don't know. Does it say if it's legal? Investor Stoli is a third party which has no insurable interest, initiates the transaction designated for transfer of the policy owner rights for someone who has no insurable interest and who hopes to make a profit. I don't know of an insurance company that will write a Stoli. I don't know that, but you should know the definition of it. Delivering the policy. So in the state of Florida, you might want to check on this for the state of Georgia or North Carolina. Delivering the policy. They have 14 days of delivering the policy, meaning you have a policy right here and you're going to go deliver it. They have 14 days to look at it, and they can get a full refund within 14 days. If they say, hey, listen, I looked at the policy, I don't want it, I'm good, they can get a full refund. And as the agent, when you are delivering the policy, it is your job to make sure that they understand it, that you collect any signatures required, and you collect any premium that might be required at that time. Explaining the policy's provisions, riders, exclusions, and ratings. I'm gonna see. I'll cover ratings and all that, exclusions on another date. But understand this. I'm gonna give you a couple of definitions here. If you see the word buyer's guide is nothing more than someone asking, hey, show me all the different policies you sell, show me the pricing, and show me how they work. A buyer's guide is only needed when it's requested. You don't have to give a buyer's guide to every person. It's only when it's requested. So what I was telling you about delivery, that is called the free look period. It is 14 days in the state of Florida. Policy summary is a written statement describing the features and elements of a policy. I mean, it's just a basic definition, basic summary of the name, address, the agent's full name, the home office administration. When does coverage begin? Coverage begins when the premium is paid with the application. U.S. Patriot Act and money laundering. Y'all just have to come back and read that because that's something that we'll come back to. So any questions on this so far before we jump into the quiz? No. If you can, kind of just unmute yourself if you have questions, because I can't see all you guys. No? Okay, cool. So we are going to go to the quiz, and I want you guys to answer this question. Put in the chat what you think the answer is. So write in the chat what you think the answer is to this question. In comparison to the consumer reports, which of the following describes unique characteristics of the investigative consumer reports? The customer has no knowledge of this action. The customer, associates, friends, and neighbors provide the report data. They provide additional information from outside sources from a particular risk, or they provide information about a customer's character and reputation.
C.
Y'all think it's C? Okay, we got C. Steffi says it's C. Jonathan said it's C. What do you think, Jason? What do you think, Fabian? What do you think, Tavian? C. Okay, let's see what we go. Let's go with C. Aha! Answer was B. So the answer says is B. Both customers and reports investigated. If you want, you guys can screenshot this. You guys can screenshot it or take a photo of it because it doesn't hurt to do that. But if not, I can bring all these questions back on one page. So both consumers reports, investigative consumer reports, provide additional information from an outside source about the customer's character's reputation, and both types of reports are used under the Fair Credit Reporting Act. The main difference is information of the investigative consumer report is obtained through an investigation and interviews with associations, friends, and neighbors and consumers. I promise you guys, that ain't that big of a deal in the question. If you missed that one, that ain't that big of a deal, so don't get overwhelmed with that. Which of the following protects consumers against circulation of inaccurate or obsolete information or financial information? Okay, so we're saying C, C. What do you think, Jade? C, D, A, B? A, B, C, D, E, F, G. So we got Ceci and Jason saying C. Let's go Fair Credit Reporting Act. Boom, look at that, Ceci. Look at that, Jason. Great job. Got that right. The purpose of the Fair Credit Reporting Act is to protect consumers against circulation of inaccurate information, obsolete information, to ensure consumer reporting agencies are fair, equitable for treatment of consumers. All right, which of the following is not an example of valid insurable interest? And the key word is not, is not. So you're looking for the wrong answer here. Whenever you see the word not, you're looking for the, okay, so Tavian and Ceci saying D, okay. I think Jade is saying D, right? And okay, let's go, let's do D. Okay, bam. The three recognized areas in which an insurable interest exists are the follows: policy owner insuring their own life, the life of a family member, a relative or spouse, or the life of a business partner, key employee, or someone who has a financial obligation to the policy owner. A debtor has no insurable interest in a creditor. Good job, guys. Good job. Let's go with 4. In insurance policies, the insured is not legally bound to any particular action in an insurance contract, but the insurer is legally obligated to pay the losses covered by the policy. What element of contract does this describe? Okay, we got A. Okay, it looks like we were unanimously for A. So a unilateral contract is the insured is not legally bound to do anything. The insurer, however, must pay the losses covered by the policy. Great job, guys. When both parties to a contract must perform certain duties to follow the conduct to make the contract enforceable, the contract is D. Okay. So you see, a lot of this stuff is definition, guys. Understand, a good tip is when you're doing this is do the process of elimination. You can automatically off the bat get rid of 2 answers. So 50-50, bring it down, use your lifeline, knock that dang thing down to 50-50. But we got unanimously D. If I can get that word right. So the contract is formed on the basis of certain conditions are met. Perfect. In classifying risk, the home office underwriting departments will look for all the following except we have Tavian saying B, Jason saying D.
Is it B?
Okay, so remember, we're looking for the wrong answer. This is all the following except. So if we're looking at an insurance policy or application, they are going to want to know about your current occupation. They are going to want to know about your past medical history and present physical condition. So everyone except Jason said B. So Jason, just make sure you read the question thoroughly, because When you see the word accept or not, you're looking for the wrong answer. So great job to everybody on that. So in classifying the risk, the home office underwriting department will look at the applicant's medical history, present physical condition, occupation, habits, and morals. You guys are doing great, guys. An individual applied for a life insurance policy and initial premiums. The insurer issued a conditional receipt. 5 days later, the applicant had to submit a medical exam. If the insured is issued, what would be the policy's effective date? You want to make sure you write this down once we get this. The policy's effective date. So Jason, are you guys saying B? Okay. C, D. Jonathan and Jason, I don't know when y'all put that B up. Okay, so you guys are going with C, D.
B.
So you guys are going with unanimous. Mostly everyone's going C. Let's check it out. Boom. So let's look here, guys. The company acknowledges the receipt of the premium with a conditional receipt, but the policy's effective date is when they do the medical exam, whichever is later. Screenshot that, take a photo of it, do what you got to do, provided that the application is found insurable. So the policy is effective the moment they submit the premium and application, but the moment they need to do blood or urine or any medical exam or any type of medical stuff, the new effective date becomes the date of the medical exam. Any questions on that? No? Okay, cool. So what is the definition of a unilateral contract? D. All right, everyone seems like they're going D. Let's go. Okay, perfect. An insurable contract is unilateral from one party. Contract is legally bound to do anything. Perfect. Which part of an insurance application would contain information regarding the cause of death of the applicant's deceased relatives? Which part of an insurance application would contain information regarding the cause of death? Jonathan says C, on the applicant's deceased relatives. I'm going to be honest with you guys. I don't know this one. This is probably very simple, but I don't know this one. So we're going C. Everyone looks like a lot of people are saying C. Let's go C. I don't know if it's going to be C. I want to say it's going to be medical information or inspection report, but we'll find out. Oh, D. Medical information on the applicant on the application includes information on the prospective insured's medical background, present health, and any medical visits in the recent years. Medical status of living relatives and causes of death of relatives. I misread that, guys. I didn't understand the question until right there. So in the underwriting process, there's one question that we ask is that if any of your parents died prior to 65 as a result of cardiovascular illness or cancer. So, okay, so we can see that. So that's part 2 of the medical question. I thought that was asking a completely different question. So great job on that. Who did get that right? So an insurer neglects to pay a legitimate claim that is covered under the terms of the policy. Which of the following insurance principles has this insurer violated? We got C. Okay, let's go see. Consideration. Boom, you guys got it right. Let's go. Great job. All right, which of the following is not consideration in a policy? Okay, so we got Jason saying C. Which of the following is not consideration in a policy? The promise to pay covered losses, the applicant's given prospective insured. Okay, so Steffi's saying B, Jason's saying B, something.
Is it B or D? I don't know.
Okay, so let's go for this. Which of the following is not considered? Which of the following is not? Which of the following is not the consideration in a policy? Well, consideration is when the person says, hey, listen, I am going to pay my part of the premium. Insurance company says, hey, listen, I'm going to make sure that I pay that. So, Tavian, you're saying A, something, and I think, Jason, you said B, Seth said B. Jonathan, what are your thoughts on that? So let's go. Let's choose B. Most people chose B. Aha! You guys got it right. That's a great job. Consideration is something. Good job, Tavian, for at least taking a guess, right? Consideration is something of value that is transferred between two parties in a legal contract. So all this is, Tavian, the definition of consideration is all it's looking for. So just make sure you go back and look at consideration. What is the primary source of information used for insurance underwriting? I cover this enough times, guys. You guys should know this one right off the bat. What is the primary source of information that is used for insurance underwriting? The primary source. What is the first thing? Okay. Tavian says D. Jesse says B. Jason says C.
D.
Sounds like we got a bunch. D. Sounds like we got some people that are confused. So we got two people saying D. Okay. Okay. Now I'm going to go with D because being in the field, Sassy, the agent is the first line of underwriting. I'm looking at you. I'm asking you the questions. So I'm going to be the primary source on the application. Not medical records the second. So great job, Stephanie. You almost got it. That's why you're the second, Camargo, not the first. But anyways, the insurer discovered that one of the applicants for a life insurance missed a couple of questions on the application. What must the insurer do with the application? So this just says, hey, listen, you took some questions down, you forgot to get some questions answered. You guys got that one, pretty common sense. Return the application for completion. Now, I will give you this, guys. If you happen to do an application and you submit it and the insurance company approves the policy and they did not catch it, they have to honor what they said. So in some part of the underwriting, if they said, hey, listen, they forgot to answer a question, which that won't happen because we're in the electronic world. You really can't get away with writing something that's not on there. But if an insurance company approves the policy and the insurance company finds out later that they approved it without going over that, insurance company has to honor it. Okay, almost two questions left, guys. When an insurer begins underwriting procedures for an applicant, what is the main source of underwriting? What will be the main source of underwriting? Come on, Sassy. No. It's not A, Jonathan. The main source, the primary source of where you get the information. Yes, it is D again. It is D again. understand this, guys. The exam will ask you the same question in so many ways. That's why I recommend before you ever look at the answers, read the question twice before you look at the answers. Note that the state records, remember how I told you they're going to throw out two random things that don't make sense that will try to sound right? See, interviews and state records were never in the text that we read. That's why you suck at tests, because they don't make sense. Well, Tavian, that's exactly why we're going to make sure we know vocabulary. Because if we can understand vocabulary, I promise you we can pass the exam. Because as long as we understand what the question's asking, we're going to kill this thing. Last question, guys, is which of the following duties and responsibilities of a producer at the time of the application accept? So all of the following duties and responsibilities of the agent, another word for producer, at time of the application accept. So if we look at the question accept, remember, we're looking for the wrong answer. So change any incorrect statements on the application by personally initialing next to the correct statement. Absolutely, don't ever do that. Explain the nature of the type of the receipt. That would be true. Probe beyond the stated questions if the producer feels the applicant is misrepresenting. So the agent, you're asking extra questions to make sure you're not lying about something, and check to make sure that there's no unanswered questions. So Tavian has chosen A. What do you else guys got? What do y'all feel? Come on, Ceci, what do you think? Okay, Jason says B, Jonathan says A. Jason, let's go back and read this question. You're looking for all the following except the following answers. So everyone chose A. You're absolutely correct. You don't, skip me to the exam. I'm already ready. I love it. So any changes, you can never, as the agent, you do never make any corrections to the exam. If someone ever makes a mistake on a paper application, all you do is you draw one line, you have them initial and date it. Like any professional documents at the bank, on an insurance application, you never initial anything. It's always the client's initial. So let's see, what do we get? Dang, guys, you guys got an 80. What? First time go around got an 80. Good job to you guys. And what I recommend, guys, is you guys can always go back and click on review quiz, and you'll see those questions that we did that you missed. As you guys see, that was chapter 1. That is all chapter 1. It took us all of 54 minutes to get through that. And that was because I was actually reading and kind of going into detail. Give me a second. I want to stop this recording.